in general, W-2 income is hard to defer, and you can do things when you're self-employed or when you have a company or when you have stock gains or investment gains, real estate, those kinds of things. But I think wages, I think you're pretty much stuck with.
Welcome, everybody. This is Buck Chopper with the Wealth Formula Podcast coming to you from Montecito, California. Today, before we begin, I want to remind you that there is a website associated with this podcast called wealthformula.com. Go check it out. And one of the things on there that I want to draw your attention to is the Accredited Investor Club, otherwise just known as Investor Club. This is where if you qualify as an accredited investor, basically that is not something you apply for, but you either are or you are not. If you make $300,000 per year or more filing jointly, or you have $1 million of net worth outside of your personal residence, you are an accredited investor. You just didn't know it. And who doesn't want to join a club? So go to wealthformula.com, join Investor Club. Now, today's podcast is going to be a conversation with a tax attorney. And while I'm not a tax professional myself, I do want to drill down on something that we touched on in this conversation briefly, but probably should go into a little bit more because I think it's so relevant for this audience. And it's called the short-term rental loophole. You may have heard me talking about this before, but, you know, if I were a high-earning W-2 wage earner, this would be really at the top of my list to implement. And I know many of you are already using it. I've talked to some of you who have used it after hearing me talk about it, which are good for you. The short-term rental loophole it's really one of those quirks in the tax code that most people don't even know exists. But once you do, it can be a pretty significant game changer for you. And here's why. Okay. So if you're a W-2 wage earner, usually when you buy a rental property, all that good tax benefit, a lot of it, depreciation losses in particular, they can't be offset by your W-2 income. They're considered passive and they get stuck in that bucket. But short-term rentals, we're talking, you know, the Airbnbs, VRBO, whatever, they work differently. If the average stay is 7 days or less, and you can show that you materially participate, the IRS doesn't classify it as passive. It becomes an active business. And that means the paper losses you generate can offset your ordinary income, even from your day job. Now, normally, you would need real estate professional status to get that benefit. But this is one of those situations where you don't. So let's walk through how it works. And by the way, you know, I keep calling it a loophole. This is black and white tax law. This is, you know, they call it the loophole. I don't even know why people call it the loophole, but the reality is that it's not. If you follow this law, it is black and white in the code. But here's how it works. Okay, you buy a residential property and usually, you know, you get depreciation. Right? The IRS requires you to depreciate the structure on paper, the walls, the roof, the foundation. And typically that's over 27 and a half years. So on $1 million property, that's about $36,000 a year. It's, you know, it's real money. But it's a little bit of a slow drip. And, you know, normally on investment property, you can't use that as a W-2 wage earner anyway. Now let's get back to that 27 and a half years on $1 million dollar thing. So there's something called a cost segregation study that we've talked about again on this show that changes that. And so instead of treating the property as one block of concrete and wood, a cost segregation study basically carves out the parts that don't last for 27 years. And namely, those are things like furniture, carpet, appliances, cabinets, even ceiling fans. Those are considered personal property and are depreciated typically over 5 years. In other words, you can depreciate them much faster. Now, that's where bonus depreciation comes in. The Trump laws now are allowed that 5-year, the stuff that's depreciated over the 5 years to be taken all at once in the first year. So here's the example. I think maybe that will help to put all this together. So you buy $1 million short-term rental. And typically, of course, you're going to finance that. And let's say it's a 70% loan to value type situation. So you're putting down 30%. You're putting down $300,000 cash. You borrow $700,000. Now, a cost segregation study, in my experience, having done it many, many times, shows approximately 30% of the property, roughly $300,000 in this case, as personal property. Okay. That's not going to be the same every time, but it seems to come out to about that amount frequently. So thanks to bonus depreciation, that $300,000 that you put down as a down payment, you deduct that entire $300,000 immediately from your taxable income. Again, let's repeat that a little bit so it's very clear. You put down 30% to acquire this $1 million property. The cost segregation comes out in such a way that you basically get $300,000 of depreciation. So effectively, you're writing it all off. I mean, it's magical. Okay. $300,000 cash, you get $300,000 paper loss in the same year. So in practical terms, again, you just deducted your entire down payment against your taxable income. And this is what real estate professionals do all the time, and why you often hear that they end up having almost zero tax liability at all. In this case, though, with this so-called loophole, it works for you as a W-2 wage earner. And for that reason, I think it's one of the most powerful tools out there for high-paid professionals. And I will say, I think it's grossly underutilized. I think a lot of people don't even know about it. Now, remember, the biggest expense for most people is the amount of tax they pay. And that is definitely the case for for W-2 wage earners. It may not be for real estate professionals, but it is for W-2 wage earners. And what this strategy is allowing you to do is to use money that you'd otherwise pay the IRS to build a cash flowing asset for yourself. Anyway, I wanted to drill down on that because I think it's really a really powerful tool. I think people should consider it. Now, for today's show, we're going to talk to a tax attorney who is going to give us a little bit more advice on, legal ways to reduce our taxes.
Wealth Formula Banking is an ingenious concept powered by whole life insurance. But instead of acting just as a safety net, the strategy supercharges your investments. First, you create a personal financial reservoir that grows at a compounding interest rate, much higher than any bank savings account. As your money accumulates, you borrow from your own bank to invest in other cash-flowing investments. Here's the key. Even though you borrowed money at a simple interest rate, your insurance company keeps paying you compound interest on that money, even though you've borrowed it. Net result, you make money in two places at the same time. That's why your investments get supercharged. This isn't a new technique. It's a refined strategy used by some of the wealthiest families in history, and it uses century-old, rock-solid insurance companies as its backbone. Turbocharge your investments. Visit wealthformulabanking.com. Again, that's wealthformulabanking.com.
Welcome back to the show, everyone. Today, my guest on Wealth Formula Podcast is Robert Wood. He's a managing partner at Wood LLP in San Francisco, one of the nation's leading tax attorneys. He's widely known for his expertise in legal settlements, M&A tax planning, capital gains strategy, and qualified small business stock. He's the author of the standard text on the taxation of damage awards and settlements, and his commentary is regularly featured in Forbes and other national outlets. Robert, welcome to the program.
Thank you. Nice to be here.
Well, let's just start right off the bat. This audience has an unusual number of high-income W-2 wage earners that, of course, W-2 earners feel like it's an immovable wall. So let's just start with some things here. What are some overlooked but fully legal strategies they can use today to meaningfully reduce tax burden?
I would say I'm more effective typically and I think in general with wage earners, there's not a lot, at least in my opinion, that you can do legitimately. I mean, obviously wages are taxed as wages. Withholding is taken out. If you live in California, as I do, the state income tax burden on top of the federal is high. So I would say it's not the answer that your audience wants to hear, but I would say in general, W-2 income is hard to defer, and you can do things when you're self-employed or when you have a company or when you have stock gains or investment gains, real estate, those kinds of things. But I think wages, you're pretty much stuck with, in my view.
Yeah. I mean, one of the things that comes to mind for me in this space, and would love to get your thoughts on, is the short-term rentals. People who are, buying short-term rentals, as long as they're W-2 wage earners, they can often get they can do the cost segregation analysis, take bonus depreciation, and as long as they're, actively participating in that short-term rental, they can offset that potentially against that income, can't they?
I think finding rather than somebody like me, a tax lawyer, I think finding a good accountant who is savvy and well-versed in those rules, I think is important. I mean, I have seen historically people who don't do it right, who claim whether it's short-term or, longer, more traditional rental real estate activities, who end up in trouble or, at audited and having deductions denied. But I mean, you're right. That's a fertile ground for people to, to have something against which, to offset some of their income. And it's, the idea, of course, with real estate is, which I know is something you're experienced in, is, the value grows over time, depreciation deductions, those kinds of things. It's how Donald Trump became wealthy, I believe.
Sure. So, the other option is to, essentially structure income through businesses. And, for someone who doesn't own a business today, again, say it's a doctor, you probably get a lot of tech executives who make a bunch of money. What are some of the ways that they could potentially legitimately structure businesses, structure things in their, to create businesses that they don't even know there's an opportunity potentially?
Yeah, I mean, it's sort of tough to talk in a generic way about those issues. I mean, and maybe it's the luxury of having, at least for me, a sort of a busy practice where people tend to bring me specific things,
Well, maybe you could give us an example that you've seen. I mean, that just as an idea.
Show you an example of things that I've seen people bringing something to me.
Yeah.
Yeah. Well, I mean, the most, and I guess you sort of said it in the introduction. The thing I see, every day of the week, really probably half of my work, I would suppose on a percentage basis, would be people who are settling some kind of a dispute. They're either paying money or receiving money. In the, tax characterization questions is what are they receiving? How can that money be optimized from a tax viewpoint? So, I mean, that's not everyone, certainly who's a listener, because hopefully you don't have any disputes. But, in today's world, people have employment disputes, they have accident disputes, they have disputes. I see a lot of founder disputes, where people are exiting a company or in a dispute over, who's entitled to what share of the profits in a business. Those kinds of things. And there are invariably tax opportunities there, and a lot of pitfalls. But I mean, as to things like I want to start a business, I mean, there are always choice of entity questions. Should it be a disregarded entity, a single member LLC, which typically is taxed directly to the owner? An S corp, a C corp. You think about qualified small business stock rules. All of those sorts of things are good to think about, at the, from the get-go and later on as well.
So let's talk about that, because I know that's a big part of what you write about is qualified small business stock. A lot of people probably have not heard of this concept at all. Can you break down what it actually is and who might qualify for this kind of thing out of business owners?
Sure. The rules are highly technical, so it's a little difficult to summarize. But I guess the headline, which will be alluring to people, I think, the headline is really for the past couple of decades. And I suppose you could say this is, in large part, Silicon Valley has been the beneficiary, but Silicon Valley is sort of all over the country now, in a sense. If you have a stock that's qualified small business stock, which is a defined term, it's got to be a C corporation. So shares in an S corporation or an LLC don't qualify. And a C corporation is a regular old, traditional corporation that, doesn't file any tax elections and pays its tax and then distributes money to shareholders. But essentially, if you sell your stock and you've met the various tests, including generally a 5-year holding period for the stock, you can exclude up to $10 million of your gain. So that means, if you sell stock in Amazon and you're lucky enough to have a $10 million gain, you can, you pay tax. Of course, you pay tax at capital gain rates, but you still pay tax. In contrast, if it's stock in a company that's qualified as a small business, then up to $10 million is tax-free. I guess notably, and it's in the news in the last few months, notably that $10 million was just raised by the big tax bill, the so-called beautiful tax bill, to $15 million. Again, you got to meet some tests. And there are various articles online, including by me, that sort of run through the tests. But getting a tax-free chunk of money, can be an enormous benefit, which is why people try to qualify.
So can we drill down on that a little bit in terms of like what? Okay, so this is a small business, and is it investments into a small business, or could it also be your own small business that you are essentially converting into stock ownership? How does that work?
There's a list of things that no matter what you do not qualify. Those are generally service businesses, such as, being a doctor, a lawyer, a dentist, an accountant, things of that sort. Service businesses don't qualify. Again, it's got to be C Corp stock. It's got to be original issuance. So if you start a company, Buck, and I buy shares from you, and then I, build it up, let's say, and sell it for a lot of money, that doesn't qualify because I bought the stock from you. It has to be issued by the company. But it could be a company. You could be a company founder and start the company and essentially build it up and be selling either entirely or in large part your own stock in your own company. And what's small, I guess, means different things to different people. Traditionally, for many years, decades, the rule was the company had to be worth $50 million or less. That doesn't sound very small, but in today's world, or even a couple of decades ago, it was easy with venture funding and that sort of thing to have a company be worth a lot more than $50 million in assets. And that's not when you later sell. That's when the stock was issued. So now, along with that increase from 10 to 15 million, now that 50 million number went up to 75. So the main thing is, if you're starting a business or you are operating a business and you're looking at selling, it's good to talk to a tax person about, in starting, what should you do? What are your plans? What's the sort of likely off-ramp? Is it going to be generational and build up in your family for decades? Or are you trying to build it up and take it public, sell it off to a bigger competitor? Those kinds of things are all relevant.
I guess one question I would have on that is, if somebody already has a business and it's qualifies otherwise, but they didn't start it thinking that they were going to use a qualified small business stock, and it's come to the point where they're thinking about selling. Is there a way to convert it to a C Corp and then utilize this kind of thing, or not so much?
It depends. It depends on, what you've got and sort of how long the off ramp might be, and also, what you own. I mean, for example, one that would work, this is maybe the easiest example, would be if you have a single member LLC, which, and these are very common in my experience. So it's your entity. Sometimes people are confused about how that's taxed. Typically, it simply passes through and is taxed on your own individual tax return. But you own all of it, or you and your spouse. And then you say, well, wait a minute, I want to incorporate, and I might be, selling in 5 years. Even though you own the business now and have already built it up, you can form a corporation, essentially trade your LLC membership interest in for stock, and still qualify for a qualified small business. So, I mean, once again, if for someone who's got a business they're starting, or a business that's underway that they may want to sell, it's good to get some tax advice about what's possible.
Yeah. Let's talk about capital gains, something you've written quite a bit about. So average investors selling stocks or real estate, what are the most effective ways to really minimize capital gains exposure? I mean, without stepping into IRS gray zones again.
There is renewed talk of opportunity zones. Those came back. It's essentially, taking your, it's oversimplified, but essentially, taking your proceeds and putting it into something that is a tax advantaged investment as a way of avoiding paying a capital gain tax. You probably, or listeners may not like this approach, but I, as a tax lawyer in California, I've seen an awful lot of people who are most bothered by California taxes. And if they have a big gain, let's say they are about to sell, their cash of a large amount of crypto that's highly appreciated, for example, or they're about to settle a career sort of lawsuit and get a bunch of proceeds, or they're about, they've been lucky enough and they have huge amounts of stock, which by the way, could be fully taxable sales or could be qualified small business stock. So they might be escaping federal tax on the latter, but not California. California at one time had a qualified small business rule for capital gain on stocks, but that was repealed a long time ago. So I do see people fairly regularly who are, before they trigger a big gain, want to look at moving out of California.
Yeah. Or potentially gifting to like a non-guarantor trust.
Yep.
Oh, a non-guarantor trust outside of California, like a Nevada trust or something like that, right?
Yeah, that, I mean, courtesy of the governor and state legislature in California, that was about a year ago, as I remember. The sort of the non-California trusts is sort of a no-fly area now. That is, it did work for years. Aggressive people would put something in a non-California trust of a certain type, and basically that gain would not be subject to California tax. But as I say, I think that loophole has been closed. And I would also say, I mean, I'm certainly not saying that moving is an easy step for at least in my experience, for someone who is young, doesn't have a lot of assets, may not own a home in California, maybe, more mobile than somebody like my age is. I mean, it can be a fairly easy thing to do, in contrast for somebody who has a lot of assets in California, has family. It's a much bigger task, and you don't want to be unrealistic about it. and then end up in trouble with the franchise tax board.
Sure. You did mention legal settlements and windfalls. Just kind of going in on that. Let's say somebody's got a settlement and, for $500,000 or something like that. What are the things they need to be thinking about in that situation?
Everyone is different. I guess it's a very repetitive area for me, and yet I'm always or continually surprised at the variations in legal disputes. And so it's important to sort of first and foremost ask sort of what the dispute is about. But there's a lot of press the last, I don't know, 5 years or actually 7 years since 2018 about the tax treatment of legal fees. So I think, and many, not all, but most probably people who are in some kind of a legal dispute and they're the plaintiff trying to receive money from somebody else. Most people in that context are using a contingent fee lawyer. So probably the first tax consideration with legal settlement is the plaintiff going to pay tax on the legal fees? And that's I guess for sophisticated people, it's a little hard, I think, to comprehend this rule. But there's a U.S. Supreme Court tax case that basically says if you use a contingent fee lawyer, it doesn't matter how you divvy up the payments or how the lawyer is paid, even if the lawyer is paid directly by the adverse party, the defense, you as the plaintiff will be treated as receiving the money and then paying your lawyer. So just to use a simple example, if it's a $1.5 million settlement, $500,000, a third goes to the lawyer. So the client usually in that circumstance ends up seeing the $1 million, and it doesn't see the other 500,000. But for tax purposes, it's pretty clear that the client in that example will usually get a 1099 for the $1.5 million. And so, the question is, can the client always deduct the 500,000? It always would be overstated, but the answer is usually yes. There's not a problem. There's a bunch of kinds of cases, employment being the best example, where it's unequivocal the client, deducts it. But I'd say, and if you gross those numbers up by a big amount, and say it's a $20 million case or something, and the legal fees are correspondingly higher, I mean, that's, I'd say, always a big concern, probably the first concern that people have.
Yeah, interesting. Just moving away a little bit with charitable planning. What structures have you seen that you think are legitimate? Like, you hear about donor advised funds, charitable lead trusts. Maybe tell us a little bit about those and, what your thoughts are.
Yeah, I mean, number one, the two that you just mentioned are perfectly legitimate. I mean, I think some people may have the impression that sort of a charitable donation doesn't involve actually benefiting charity, and that it's some kind of a tax write-off without a cost. And that, of course, isn't true. I mean, the things like the donor advised fund and charitable lead trusts and other things, creating your own private foundation. I mean, these are all involve tax write-offs, a tax deduction, but you're still spending money. You're giving money to somebody else. So, but I mean, all of these things, I think when you look at the amount of someone's income, their age, their family, I mean, some people, older or wealthier people may want to be helping their kids with sort of a kind of a full employment to be running a charitable organization. And there are rules about related parties and, what's arm's length, but there's nothing illegal about doing that. And it can be, doing good works at the same time. But I'd say, in the tax world in general, if something is, totally free and the government pays for it and it doesn't cost you anything, I'd be wary of those things because, sometimes people end up with tax problems because they got lured into something by a promoter.
Yeah. What types of things are you seeing out there that are making you weary? I'm just curious. People probably, clients probably run things by you all the time.
Yeah, I mean, I don't see as many, I guess, fortunately, as I used to. But you're right. I mean, I do see things that are being, essentially products that are being promoted. I'm sure you're aware. I mean, there have been various, I guess you could call them tax shelter eras, where essentially very sophisticated, sometimes intentionally complex structures were put in place, frequently involving partnerships where you'd be investing in something. And just to use a kind of crazy numbers from that era, and you put in $100, but you got $1,000 worth of tax deduction right away.
Mm-hmm. Like conservation easements, for example.
Yeah, and actually, yeah, I mean, so it's not that everything, of that sort you should run the other direction from, but you definitely, before you sign on the dotted line or write a check, you definitely should get some independent advice from somebody who's not, basically selling or marketing it. I probably 9 out of 10 of those kinds of things that I look at, I end up saying, look, I wouldn't do it, and here's why. But that doesn't mean everyone, is going to be conservative or is going to follow that advice. You mentioned conservation easements, and that's a great topic. I mean, the IRS it's not that that this tax deduction is illegal. The idea is that the basic idea is that you have an investment as an owner or part owner of land, and you essentially are, not building a building on it, but you're agreeing you're not going to build a building on it, or it's going to stay open space or something. I mean, there's been a lot of tax law on those subjects for many decades. And I've seen them and done them successfully. However, there's a big industry of syndicated ones that are highly aggressive. The IRS has made it really clear they don't like them. So I think it's more important these days for people to be sort of careful buyers if they're going to go down that road.
Another area that I've seen and makes a lot of sense in many ways, but has become very much scrutinized by the IRS is the area where business owners self-insure, the so-called captive insurance type situations. Tell us a little bit about that. Where I haven't heard, I think captives were also always on the IRS Dirty Dozen list or whatever, but there's legitimate tax law there that people are trying to take advantage of. What are the things that make a captive much more likely to be legitimate than not legitimate?
Yeah, I'd say I'm certainly familiar with the topic, and you're quite right that the IRS has not liked captive insurance structures or products for years, decades even. You mentioned the IRS Dirty Dozen list. I mean, that's a good thing to mention in the sense that, if you are, and conservation easements is on it as well, if you are doing something that's on this so-called Dirty Dozen list, I mean, the name of that list should tell your audience right away. It's something the IRS, has identified in kind of a systemic way as a problem. It doesn't mean you can't go down that road, but it should tell you that you may be buying yourself a dispute. And do you want to do that? Or is there something else that you can do that might be on the Dirty Dozen list 5 years from now, but it isn't now? But I mean, the captive insurance idea just, in essence is you're a business owner, you're paying, let's say $100,000 a year to, Lloyd's of London or Allstate or somebody for insurance of various types. And what if you took that $100,000 and essentially self-insured and plowed that money every year into your own kind of insurance company? And then the idea is, hopefully, if you don't have claims, that money is building up on a tax-deferred basis because, you're deducting the $100,000 you'd pay to a third-party insurance company every year on your taxes, and you can deduct the payments you're essentially making to your own insurance company. Again, I'm oversimplifying, but that's the basic idea. And the IRS was seeing a lot of people who end up with quite a large stash of money, and which is why they target it and try to make sure that people are complying with the rules.
Got it. If you're, I want to make sure we have some just takeaways. When you're talking to, say a high paid physician or lawyer, and, you talked about service industries, which makes it difficult, and they are W-2, and they come to you and say, well, okay, maybe I don't have a lot of things I can do now, but if you or me, what are some of the things that you would think about in the future in order for me to not only, to save taxes legitimately? What sort of framework would you give somebody to think about?
Yeah, I think again, I may not be the best person to, given what I've said, to talk about things you can do as a wage earner, because it's really, I obviously, everyone knows, I suppose, from the news that some years ago, when there were all the stories about the CEOs who were taking $1 of pay. And of course, that's because they want equity instead. And that's clearly a better deal. So that the big pay packages that Elon Musk were, on a much smaller scale, getting equity is always better than regular pay. But most of us don't have those choices. So, but I think you hit the nail on the head when you asked about real estate. You asked about, other businesses, retirement funds. Of course, if you're a W-2 earner, you have whatever it is that the company provides, typically, whether that's 401k or something else. But you don't have earnings from something else. It's really, is there a side business? Is there a real estate activity? Those kinds of things would be, a way to build up wealth more than, wealth with lower taxes more than W-2 earnings would be.
When we're talking about retirement accounts, people, you read, I read about people talking about backdoor Roths or mega backdoor Roths. Can you explain what that is and how they work?
I'm not sure that I can. There was a lot of press over, I think it was Peter Thiel, about, having a Roth IRA that was worth, I don't know, hundreds of millions, or maybe it was billions. I don't remember. Most a Roth IRA is essentially where, tax has been paid. So unlike, when the money goes in. So unlike a regular IRA, which is more like a traditional retirement account or 401k, money goes in, it's a tax deduction or non-taxable when it goes in, but then when it comes out, it's taxed. So I think, there are strategies. It's sort of not my area of practice, but there are strategies about, when to convert, how to optimize the size. I think after the Peter Thiel press, if I recall correctly, there was an effort made to limit the size of Roth IRAs. I don't think that passed. But it's another area where, someone with investments could look at, building up wealth.
Any tax laws that you think may change and fundamentally, that people should have a radar out right now that could that they should be thinking about and potentially planning for?
I mean, I'm not an estate planner, but there's always discussion about, the estate tax laws and ways, again, for people of large wealth, how to pass assets to their kids without gift or estate tax. The idea of, in real estate is another prime example there, the idea of trying to, pass things to the kids when the value is low and it's expected to appreciate. I mean, I've seen this done with crypto too. The idea is, rather than using up a big chunk of your unified credit against gift and estate taxes, if you can use a small piece of it and have the asset grow in value. I think that's the kind of thing that families think about. But as I say, what I tend to see, which is why I'm on some of these topics, I rarely see them. But what I tend to see is somewhat targeted tax questions, like, I have this building and here are my choices about selling. What's the best? Or I'm starting this company, or I started this company 5 years ago. Here's the size now. What are my choices? If I were to sell, or again, the lawsuit, over my interest in a company that I co-founded. How do I optimize that? How do I solve, or what's the least amount of tax I can legitimately pay on a sexual harassment or some other kind of, employee discrimination case, or a case with large punitive damages? Punitive damages, no matter what kind of case, are always taxable. So I see a lot of those, which I know are somewhat unique. But there are a lot of lawsuits out there. So I guess I see a lot.
Yeah, sure. Well, if someone has an issue like that, how do they get a hold of you, Robert?
My website is woodllp.com, and my email address is wood@woodllp.com, and my phone number is on my website, and it's 415-834-0113. I'm old fashioned. I still answer my own phone, but yeah, I'm pretty easy to reach for anybody who has questions or whom I might be able to help.
Great. Thanks so much for being on the show today.
Thank you. Nice meeting you.
You make a lot of money, but are still worried about retirement. Maybe you didn't start earning until your 30s, and now you're trying to catch up. Meanwhile, you've got a mortgage, private school to pay for, and you feel like you're getting further and further behind. Now, good news, if you need to catch up on retirement, check out a program put out by some of the oldest and most prestigious life insurance companies in the world. It's called Wealth Accelerator, and it can help you amplify your returns quickly, protect your money from creditors, and provide financial protection to your family if something happens to you. The concepts here are used by some of the wealthiest families in the world, and there's no reason why they can't be used by you. Check it out for yourself by going to wealthformulabanking.com.
Welcome back to the show. Hope you enjoyed it. Of course, some of this stuff was maybe not relevant to all of you, but I do want to bring you back. If you get one thing from the show, one thing only, let's talk about that short-term rental loophole. Again, talk to your CPA about it. Look it up. Put it into ChatGPT or something like that. Get all the codes. Bring it to your CPA. There's no reason why they should say this won't work. Now, there is certain qualifications that you have. You have to make sure that you're materially involved with that short-term rental and such. But listen, there's a lot of people doing it here, and there's no reason you can't. So anyway, that's it for me this week on Wealth Formula Podcast. This is Buck Joffrey signing off.